Good morning, everyone. My name is Peter Federico, and I'm the CEO of the Workers' Compensation Board, and it's my pleasure to share some information with you this morning about the changes that the board has approved to our rate-making process, the rate-making model, and to share with you the impacts that change would have had, those changes I should say, would have had on your 2017 premium rate had we implemented that model for the 2017 premium rates. So before we start, just a couple of maybe housekeeping things, which I've in the past been remiss about doing that. The emergency exits, there's one to my left over there, and also one to the right over here. Washrooms are just at the back of the room there. And I would ask you to, if you haven't already done so, please mute your cell phone so as not to disturb the rest of the folks. So welcome to all of you, and welcome to those that are joining us by webinar. Much better morning this morning than it was yesterday. It's amazing when we were driving over from the hotel this morning. Yesterday the temperature gauge on the vehicle said -12. But when we got out of the vehicle here, I think it felt like -37. This morning the temperature says -21, but it actually feels a bit like a spring day this morning. So thankful that the weather has improved. So as I said, what we're going to share with you this morning are the changes that will come into effect for establishing the premium rates for 2018 based on enhancements to the current rate-making model. We are not showing you what your 2018 premium rates are because we actually don't have enough data at this particular point in time to forecast what those premium rates would be. But what we're going to show you this morning is a proxy for what the impact might be for 2018, plus or minus changes in the actual injury experience over the next year, by showing you a comparison between the 2017 premium rates as they exist today and what those premium rates would have been had we implemented the model in 2017. Now, why didn't we implement it for 2017? As we go through this, you'll see that some of the impacts we're going to show you are fairly significant to some of the individual rate codes. And so in order to allow enough time for people to kind of absorb the changes and the impact of the changes, perhaps plan for those changes, the board suggested that we go through this process of providing some information about the changes before we actually implement and give employers the opportunity to actually plan ahead a little bit. They were planning to spend about 2 hours here this morning. We've got quite a few rate codes to go through. I'm going to go fairly quickly over the first kind of part of our agenda as it relates to the WCB background. I would encourage you, if you haven't already done so, to go to our website, www.wcbsas.com. On that website are actual video presentations that we gave in November and December, regionally, at very high level, that will also give you additional background with respect to the WCB. So I'm planning on spending, give or take some time, about the first hour, just taking you through the enhancements to the model, reserving the last hour for any questions that you might have here with us in Saskatoon, or those of you joining us online. And at the end, I will actually provide you with some information on how you can forward questions after today's session and the feedback that we're seeking from employers with respect to implementation of the enhanced rate model. So why do you pay WCB premiums? Why does WCB exist? Again, very quickly, prior to 1915, in Canada at least, there was no such thing as a workers' compensation system. There was no workplace injury insurance. In the event of a workplace injury, the only recourse that an injured worker had was to actually sue their employer. And in most cases, injured workers did not have the resources to actually even hire a lawyer to proceed with filing of a lawsuit or pursuit of a lawsuit against the employer. And in most cases, even when they did pursue that, very few of them were actually successful in proving negligence on the part of the employer. However, when they were successful, it often led to the demise of the employer, forcing the employer into bankruptcy. Neither one of those situations, either from the worker's perspective or the employer's perspective, were very good from an economic perspective. Particularly in Ontario, in the kind of early 1900s, the Ontario government noticed a significant increase in the utilization of their social security programs, driven by injured workers who had no means of providing for themselves or their families in the event of a workplace injury, who could not sue the employer, who could not gain compensation in any form, could not pay for the medical that they needed, and had no compensation. And so what was happening to those workers is they were going onto the social security system, became a problem of the government. And this became a fairly large problem. So in 1913, the Ontario government hired a guy by the name of William Meredith, asked him to study the situation and propose an alternative to what the current situation was. And as a result of Meredith's work, he came up with a first workers' compensation system which was legislated in Ontario in 1915. And Meredith's proposal has become known as something based on a historic compromise, a deal that he struck between workers and employers. Workers agreed that they would give up their entitlement to sue the employer, in exchange for which the employer agreed that they would 100% fund the workers' compensation system. So workers said, we want to ensure that we have guaranteed benefits in the event of a workplace injury, and for that we will give up our right to sue you, but in exchange for that you have to ensure that the system is funded well enough. You have to be 100% responsible for the costs of that system to ensure that our benefits are never in jeopardy. Meredith's model was based on 5 principles, and I'm not going to, in the interest of time here, I'm not going to go through all of those 5 principles, but 2 of them that kind of really focus in on the enhancements we're going to talk about today have to do with, first, the overall nature of the program. So one of the first principles that Meredith talked about was that the system had to be based on no fault. There was no need for the worker to prove that there was any fault, no need for the employer to contest that claim on the basis that there was fault on the part of the worker. It was totally a no-fault system. The second important principle, they were all important, there's 5 of them, but the second important one that's very relevant to our discussion here this morning is this concept of collective liability. So what collective liability meant from Meredith's perspective was that all employers together collectively must share in the liability and costs associated with that compensation system. So many of us will be familiar with collective liability because really it's a fundamental element of any insurance program. So if you think about your home insurance or your car insurance, in the event that you have a house fire or some water damage to your house, you're in a vehicle crash, you don't actually have to pay out of pocket the total cost of the repairs or replacement. Instead, you've paid a premium over the years, and that premium then provides you with the coverage in the event that something's happened. So how is that possible? Well, it's because all of us are grouped together in these things called risk pools from an insurance perspective. And based on the experience of that particular risk pool, so depending on perhaps the size of your house, the construction of your house, whether it's wood or brick, if you have fireplaces, do you have smoke alarms, do you live in Tornado Alley, do you live in a floodplain, you will be grouped in these risk pools with similar homeowners and pay a premium, and that premium now insures you or guarantees you that in the event of a loss, the pool will actually pay for the replacement cost of that. You don't have to dig into your pocket because you've been paying these premiums along. Well, that same concept applies to workers' compensation. And Meredith envisioned that the only way the system could be affordable and work is if employers together shared in the collective liability of the costs of all of the system. Those 5 principles in this historic compromise continue to be kind of the linchpin or anchor of workers' compensation programs in Canada. And while not exactly adopted, really the fundamental principles that Meredith envisioned anchor compensation systems around the world. So what's the process by which we actually establish premium rates? How do we determine what rate you should actually pay? There are actually 3 steps in determining ultimately how much an employer will pay us. The first has to do with industry classification. So in Saskatchewan, we have 47,000 employers that are registered with the Workers' Compensation Board. We take those 47,000 employers, and just like homeowners or car owners, we group them based on their primary business activity, with the assumption that if you're in a similar business, the risks associated with that business are going to be the same. So we take those 47,000 employers and we divide them up into these things called industry rate codes. And there are 50 of them in Saskatchewan. So different types of manufacturers, which is what we're talking about here this morning, will be grouped together. The bankers will all be grouped together, the lawyers all together, and collectively in those 50 rate codes, they will be responsible for all of the costs associated with all of the injuries that occur to that group of employers in that industry rate code, with a certain element of this collective liability supporting all 50 of those rate codes. And we'll get into the details of that as we get into the elements of the rate model itself. So the first starting point is to determine which industry rate code you belong in and grouping you with employers with a similar business activity, similar risks, to share in the costs of all the insurance claims within that particular industry rate code. The second step is to actually determine, on the basis of the collective claims in those rate codes, what the premium should be. So what we're attempting to do in setting the premium rates is collect sufficient money today to pay for all of the costs that are going to happen this year. For all of the injuries, I should say, that will happen this year. So we started the 2017 rate setting process in the fall of 2016. And so sitting in kind of August, September of 2016, we were predicting the claims and claims costs that would occur in 2017. And every employer in that particular industry code would pay the same base premium rate for all of the injuries that would occur in 2017. So we're not trying to collect money for claims that happened in 16 or 15 or claims that might happen in 18. We're establishing a premium rate sufficient enough to pay for all of the costs associated with all of the injuries that will occur in 2017. And as we get into the enhancements to the rate model, I'll talk about in greater detail about the actual process by which we determine the industry premium rate. After step 2, we arrive at something called the base industry premium rate. And again, repeating myself, but every employer in a particular industry rate code would start out by paying the same base premium rate. So if you think about what we've published in terms of 2017 premium rate, the average premium rate is $1.24 for 2017. That average is not really the premium rate that any particular rate code would pay in 2017, but rather it's the average of all 50 rate codes. Now, throughout the presentation this morning, you're going to hear me use the term board level or board level experience. And when I use that term, what I'm referring to is the experience of all 50 industry rate codes collectively. So when we look at the experience of all employers registered with us, how much premium do we have to collect for 2017 in order to fund all of the injuries that will happen in 2017. And under our current model, the model determined that $1.24 is what on average we need to collect in order to pay for all of the injuries that will occur in 2017. When we get down to the industry rate, though, the industry premium rate will be quite different than that average because it's based on the experience of that particular rate code. But every employer at that rate code level starts out by paying that industry-based premium rate determined after Step 2. But recognizing that individual employers will have different experience and wanting to hold individual employers accountable for their own injury experience, we introduce something called an experience rating program after we determine that base premium rate. So again, this is not dissimilar to what we experience with our auto insurance or our home insurance. If we have more claims against our home, if we have driving infractions or claims with our vehicles, we will actually pay more. We will get a surcharge, if you will, applied to the cost of our insurance, and we're going to pay more to SGI or whoever our insurer is. If our claims experience is positive, we as individual drivers or homeowners are going to actually see a reduction in our insurance costs. We will get a rebate or a discount on the insurance that we would pay for those. We apply the same principles to workers' compensation. So if an employer has bad injury claim experience, they're going to pay more through the experience rating program. If they have good injury claim experience, they're going to pay less. The experience rating program is divided into two programs. One called the standard program, which was designed for smaller employers. We define smaller employers as an employer who's paid us less than $21,000 in premium for the 3 most recent premium years. That program is based on frequency, the number of claims. And depending on the number of claims that you have, you could get a discount on your premium rate of up to 25%, or if you have a large number of claims, you could pay a surcharge of up to 75%, over and above your base industry premium rate. The second program is called the Advanced Program, and this is designed for larger employers who paid us at least $21,000 in premium over the previous 3 years. That program is cost-based. So it's not based on the number of injuries you have, but rather on the cost of those injuries. And if the cost of your injuries as an individual employer is greater than the average for your rate code, for your industry group, you're going to pay more, up to 30% more. If your injury experience is better than the average for your industry rate code, based on the cost of your claims, you're going to pay less, up to 200% less than the industry-based premium rate. So at the end of the day, when you write that check to us to pay for your premiums for 2017, you're going to be writing us a check for the base premium rate plus or minus an adjustment for your own individual experience through the experience rating program. Well, what I'm going to share with you this morning in terms of enhancements to the rate model in no way alter that experience rating program. We're only going to be talking about how we determine that industry-based premium rate, which is what the changes are about. We will still apply the same experience rating to that base industry premium rate under the enhanced or changed model. So why did we undertake this review in the first place? Well, this all began with an overall review of what I call our financial system. And our financial system is, how do we invest the money that we have? How do we determine the level of funding that's required? How do we determine the annual premium rates? Are all critical elements from the revenue side of our business. So you may have gleaned from what I said earlier that we survive 100% on premiums paid by employers, supplemented by whatever we can earn from investing those premiums that employers pay us. So I mentioned to you earlier that we collect all of the premium necessary to pay for all of the costs associated with injuries that will occur in 2017. We will pay those costs over some period of time. We don't pay all of those costs in 2017. On extremely serious claims, long-term claims, we could continue to pay those compensation costs for up to 50 years. So we have a young worker injured at, let's say, the age of 15. Our wage loss benefits end at age 65. If we have an individual who has a serious injury at a very young age and has permanent loss of earnings, we will continue to pay those wage loss benefits until either the worker is able to fully recover and earn their pre-injury wage or reach the age of 65. But we're collecting the present value of all of those costs today and investing that at a particular rate of return necessary for us to fund all of those future cash flows that are required in order to pay those future costs of claims. Because we don't pay all that money out today, what we do is we take that premium and we invest it in our investment portfolio, which is managed by external investment managers. We have about $1.8 billion in investments under management today. If we don't generate sufficient return out of that investment portfolio, we will be short at the end of the day in terms of having sufficient revenue to pay the future costs of claims. So it's kind of like if you think about us creating a savings plan or a pension for ourselves. We determine how much money we want in retirement. We set that money aside, invest it at an assumed rate of return, and the combined principal invested together with the return on that principal is the money that we will then have to provide us with that pension for ourselves out of our RSPs when we actually retire. Same concept applies. So when we began the review of the financial system, we wanted a review of the manner in which we were investing these funds in terms of which asset classes we had these funds invested in. So we have funds invested in Canadian equities, in US equities, in global equities, in bonds, in real estate, in mortgages. And what we're interested in determining is having an independent review done to optimize what percentage of the portfolio ought to be invested in those various asset classes. So we began by going through this 18-month process where actuaries helped us run different models to determine how we could maintain that minimum rate of return required in order to fund those future claims costs, but reduce the volatility in the returns. So we were prepared to sacrifice huge returns on our investment for a more stable return on investment because we have to rely on that in order to be able to pay these future claims costs. Once that was done, we decided we needed an asset liability study. And so we hired an actuarial firm named Eckler who came in and conducted this asset liability study. An asset liability study simply evaluates the degree to which this investment portfolio over here matches the actual behaviors of the liabilities that we have on the claim side. And was the strategy with respect to optimizing the investment in our portfolio a good strategy in terms of ensuring returns and reducing volatility of those returns? So Eckler came in and did this review, and he concluded that yes, in fact, our investment policy was a good policy, and the distribution of the investments across these asset classes ought to optimize our returns. But in the process, he said, if you're looking at your financial system, you should really look at the manner in which you're setting premium rates, because the model has been in place for a while and could probably stand a review. And so for that, and hearing from employers that they felt, particularly in recent years, that the model as it exists today was not reactive enough to changes in their injury experience, we proceeded with a review of the rate-making model. And we hired Eckler again to conduct the review of that rate-making model. In the process of establishing the model, there were kind of 4 key principles that we were trying to maintain, principles that are often seen as competing principles. So on the one hand, we wanted to ensure that employers and individual industry rate codes were accountable for their own injury experience, to minimize the cross-subsidization that was going on among the 50 rate codes. But at the same time, we wanted to balance that with collective liability. So I said that collective liability means that employers together share collectively in the liability. But it also means that employers, individual employers, should not be unduly burdened by extremely expensive or unusual claims. And so the collective liability helps to balance that part of these extremely expensive claims and spreading the liability over a broader base. But at the same time, we want to ensure that employers are truly accountable for their own claims. If we increase the accountability too much, we decrease the liability too much and put too much undue stress on employers. If we try and increase the collective liability, we unfortunately decrease the accountability of employers for their own injury claims. On the other hand, we recognize that employers need to have some assurance that we're not going to whipsaw you in terms of the premium rates. In other words, that there's some stability in the premium rates. You're not going to see huge increases one year and then huge decreases and then increases again, that there is some stability in the premium rates. But balancing and competing with that is the reactivity of the model. So if we make the model extremely reactive, what's likely going to happen is we're going to create extreme volatility in the premium rates, instability. But if we seek to stabilize the rates too much, we now hold back the reactivity of the model with respect to current experience. So balancing these 4 principles in as transparent a way as possible was kind of one of the thoughts at the forefront as Eckler conducted this rate model review. Again, what was the kind of overall purpose? Improving or increasing the predictability of costs such that the premiums that are based on the predictive costs are sufficient to pay the future claims associated with injuries that occur in that premium year, and ensuring that the model is fair and equitable among all employers. So those were kind of the key things. In addition to balancing these principles, it was really about how can we improve the predictability of costs that allow us to determine more accurately by holding employers accountable and balancing that with collective liability, making the model reactive but not making rates too volatile, such that this was fair and equitable among all employers. So what were the key findings coming out of the rate model review? Well, Eckler determined that the rate model as it exists today is sound. In other words, it is generating sufficient premium to pay the future costs of claims in that premium year at the board level. So when we calculated that $1.24 average premium rate for 2017, Eckler said the model you're using to forecast that average premium rate is accurate. At the board level, when you take the collective experience of all 50 rate codes, you're collecting sufficient premium to pay for the future costs. The model is sound at that level. However, when we drilled down to the individual industry rate codes, it was not doing as good a job in terms of setting the premium rate for the individual rate codes. So while the roll-up of all of the costs was accurate, as we distributed that among the 50 rate codes, it was not doing as good a job in terms of accountability and reactivity and stability as perhaps it could be anchored on kind of more solid actuarial principles. Interesting enough, we actually ran, well, you'll see, we ran the 2017 model under the enhanced model and compared that to the existing model. And when we look at the average premium rate generated by the enhanced model, it came out exactly at $1.24. In other words, even with the enhancements to the model, this is not generating any additional revenue for us as an organization. It's simply redistributing this on a more fair and equitable basis across the 50 industry rate codes. So Eckler concluded the model needed some refinement, but not a total overhaul. It was not broken, but it certainly did need some enhancements to improve the predictability at the individual rate code levels and make it more fair and equitable among all employers. Eckler had 7 recommendations, and I'm going to go in a few minutes into detail on most of those recommendations, except for one which I want to cover off right now, and it's the second one that has to do with classification. I mentioned to you a few times now that we take the 47,000 employers and we divide them up into 50 industry rate codes. The reality is, as a result of doing that, and it's on the basis of primary business activity, some of those rate codes are extremely small. We have some industry rate codes that have fewer than 20 employers in them. And so what our current model does, and this is maintained in the enhanced model, our current model actually looks at past experience to help us predict future experience. So we have a very small industry code with very few employers and very few claims going through it. We calculate a 5-year average under the current model to predict future costs. If we have very few employers with very few claim experience going through that 5-year period, it's not very credible or reliable in terms of predicting future costs. They're very, very small. The sample size simply isn't large enough. And so what Eckler noted is that we in fact did not have a process whereby we periodically and systematically review the classification structures. And Eckler recommended that we actually build a process such that there are periodic and systematic reviews of the classifications, with the thought of perhaps merging some of these extremely small industry rate codes. The board has decided that we were not going to undertake anything in particular with respect to that recommendation except for building the process. We do not have a current process to periodically and systematically review classifications. Rather, it's done on an ad hoc basis. You know, this just isn't fair. Yesterday, I actually had to compete with the forklifts in the background, and then when Phil got up and did his presentation, later in the day, there was no activity going on before. I swear to God, you're the one who's actually gone downstairs and told him to start up those forklifts. So those of you listening online, if you hear some noise in the background and it's not my tummy or anything, there's a forklift running behind me. So we do not have a process whereby we kind of periodically and systematically review these. The board has asked us to build that process, and we will do that. In the meantime, there are no immediate plans to merge any of the individual industry rate codes. So we will maintain the 50 rate codes as is until we build this process. You can perhaps imagine the analysis required to proceed with a review of the classification structure can be fairly arduous. And as we combine, say, some of these smaller rate codes, if we were to merge some of these smaller rate codes, there would be winners and losers, because we would be bringing in the experience of employers from one rate code and grouping them with another. Somebody's experience is going to be better than the others, and it's going to trigger an increase in one group and a decrease in another. We would want to consult with the employers that would be potentially impacted by those mergers before we proceeded. So, first of all, we'll build that process, which probably is going to take us the remainder of the year to actually get the analysis and building the process. And then it'll be really, quite frankly, years before we actually get through all 50 and give consideration to potential mergers of those rate codes. So no activity, no action on that particular recommendation other than to build the process itself. So what about the other recommendations, and what are the impacts of these recommendations on the M codes that we're going to talk about here this morning? So the first thing I want to remind you of before we get into the details of the impacts is we are not going to show you your 2018 premium rates. We're simply showing you a comparison of the current 2017 premium rate to what it would have been had we implemented these enhancements. And we're going to go through each of the elements, each of the recommendations that Eckler made, again with the exception of that classification one, and show you the impact of that particular enhancement had we implemented January 1st. At this point, I simply want to kind of warn you not to get too excited or stressed, either positively or negatively, as you see the individual elements, because all of the enhancements actually work together to build a better model. So you'll see some increases in some of it, they'll drive increases potentially from some of the enhancements to the individual rate codes, and others that will drive decreases. So not until we get to the end should we actually decide whether we're excited or happy or stressed or whatever. The 2018 premium rates will be determined throughout this year as we gain more experience that help us predict what the 2018 experience is going to be. So as I said, we do not have data today to actually forecast the 2018 premium rates. Those will be released as we have done historically in the fall, and will be adjusted for any changes in the experience, the actual injury experience that occurs that would impact the 2018 premium rates. So the first recommendation has to do with credibility, and it is very closely related to this issue of classification. So as I said, the current model uses historical spending patterns. We calculate a historic average, and we use that average to predict what the future spending might be. And under the current model, we use a 5-year average for all 50 industry classifications. Now, because some of those classifications are very, very small, in order to increase the stability of the premium rate, what we've been doing is we've been adjusting those 5-year averages at the industry level by the overall experience of all 50 rate codes. So at the board level. So first we calculate the 5-year average for the individual rate codes. We say, boy, there's 17 employers in that rate code. This is a non-credible, non-reliable rate code. We have to add credibility to that, and what we're going to do is we're going to adjust that experience for the overall experience for all 50 rate codes together in order to provide some stability to the premium rate and recognize the volatility. What credibility really means is the reliability of historic spending patterns to predict future spending patterns. So in order to compensate for the lack of credibility, the lack of reliability of experience at the industry level, we simply adjusted that for the overall board level. Now, Eckler recognized the volatility, the lack of credibility or reliability at the industry code level. And he said, you need to take that into account. But the way you're doing it is actually diminishing the accountability at the industry level, because you're effectively smoothing the experience of the industry by applying the overall experience of all 50 rate codes. So what Eckler suggested, recommended, and we've accepted, is that where the industry code is not credible, instead of looking at just a 5-year average, you expand that to now include 10 years of experience, because you'll gather more experience, and that makes the experience at the industry level more reliable in terms of predicting the future. So how do you determine credibility? Well, Eckler said you should, under the current model, we look at payroll. Eckler said that's not reliable. Payroll's too volatile. You shouldn't be using that. It's not really reflective of the experience at the industry level. What you should be using is costs. So what Eckler has said and what we've adopted is that if an industry has minimum $16.5 million in claims costs going through its rate code over the previous 5 years, it would be considered 100% credible, which means that the average of the last 5 years is reliable in predicting the experience for next year. But where an industry code has less than $16.5 million in costs, you cannot use 100% of the 5-year average because that's not reliable. What you should use is a blend of the 5-year average and the 10-year average. Let me give you an example to explain. $10 million of costs running through a rate code equates to about 60% credibility. So if an industry group is 60% credible, they've got $10 million of costs going through it over the last 5 years, we would calculate the 5-year average and we would take 60% of that 5-year average. Then we would calculate the 10-year average and we'd take 40% of that 10-year average. So their historical experience for 5 years is only reliable 60% of the time. But their experience over a 10-year period, 10-year average, is credible 100% of the time. So that's how we determine the level of credibility. Now, what does this mean to individual industry rate codes? So first of all, if your individual industry experience is worse than the average for all 50 individual rate codes. So remember, what we were doing in the current model, we were smoothing or adjusting individual non-credible individual industry code experience by applying the experience of all 50 rate codes. If we remove that smoothing and the individual industry rate codes experience is worse than the average of those 50, the premium rate's going to go up. If the 10-year experience, so let's say you're a non-credible industry, you're not 100% credible, which means we have to use a blend of 5 and 10-year averages. If your 10-year average experience is worse than the 5-year, by picking up even a portion of that 10-year experience, it's going to have the effect of driving your premium rate up. Conversely, if your experience is better than the average of the overall 50, this would drive your premium rate down. And if your 5-year costs are higher than your 10-year costs, this is going to drive your premium rate down. So let's look at the individual industry codes and see the impact. So M33, which is refineries and upgraders, would actually see a decrease of 2 cents had we implemented this January 1st, 2017. The overall experience of M33 is better than the overall average, so it actually drove down the premium rate. However, they're only 41% credible, which means we would only use 41% of their 5-year experience and what? 59% of their 10-year experience. Their 10-year experience is actually higher than their 5-year, so we're bringing in a greater portion of the 10-year experience. It would have the effect of driving the premium rate up. But the combined effect of the two is a net decrease in the premium of 2 cents had we implemented this January 1. M62, which are mills and semi-medium manufacturing, same kind of effect. The overall experience was better than the board experience. However, this rate code is 100% credible, which means we will rely 100% on their 5-year experience. That had absolutely no impact. One other element, however, that I forgot to mention, 2 things actually. So in order to smooth premium rates on non-volatile industries, what we would do is we introduce something called blending. And so we would effectively calculate the average of the 2017 rate and the 2016 rate, and that's what we would actually charge you. Because we recognize volatility in the small industries. So what we're currently doing is we let the 2017 model run as it is for the individual industry level. But when we see volatility in the premium rates, in order to smooth that volatility, we grabbed the 2016 premium rate and basically calculate an average, and that's what we charge you to take out the big bumps in the premium rate. The other change, though, in the model has to do with this 5 and 10-year experience. And one of the things I forgot to tell you is under the current model, we use 5-year averages except for medical costs and vocational rehabilitation costs. There we've only been using a 3-year average. Because of the activity or movement in medical costs relative to the growth, we believe that 3 years was more reliable. Eckler said, no, you cannot, in order to maintain integrity of your model, you cannot differentiate among benefit types. So the current model actually uses 5 years for all benefit types regardless. So we do not differentiate between wage loss or medical or vocational rehabilitation or anything else. It's the 5-year average of all costs. By moving to a 5-year average as opposed to a 3-year average for those medical costs actually had the effect of bringing the M62 premium rate down as well for a net decrease of 8 cents had we implemented this January 1st, 2017. M81, which is metal foundries and mills, would actually see an increase in the premium rate. Their overall experience was worse than the board average. So by removing the smoothing effect of the 52 rate or 50 rate code experience, it actually had the effect of driving up their premium rate. They're only 48% credible, so we're picking up 52% of their 10-year average, which is lower than their 5-year average, so they actually benefit from that. But the net impact would have been a 23-cent increase in their premium rate had we implemented January 1st. M91, a similar story. However, the net increase would be a 7-cent increase, so their experience is very similar to the industry average. However, they're only 76% credible, and so picking up a percentage of their 10-year average has the effect of netting to an increase of 7 cents. M92, which is machine shops, in manufacturing, their experience is better than the overall average. They are fully credible. They're 100% credible, so we're only looking at 5-year experience. That had no impact. The net result would have been a 4-cent decrease in their premium rate. And M94, which is iron and steel manufacturing, would have seen an 8-cent increase. Although their experience is better than the average of all 50 rate codes, which would drive their premium rate down, they're only 67% credible, so we're picking up 33% of their 10-year experience, which is worse than their 5-year, and that has the net effect, would have had the net effect of increasing their premium rate by 8 cents. So on to the next recommendation, which has to do with the use of indicators to predict costs. So under the current model, what we do is we seek to first estimate the number of claims we're going to have. So when we were setting 2000 premium rates, we're first starting is to estimate the number of time loss claims we would have in 2017, and then determine what the average cost of those claims are in order to forecast what the cost would be in 2017 and accordingly the industry premium rate. Eckler had a look at that and he said, here's the fundamental problem with that. So I think as many of you will know, we have seen significant reductions in our time loss injury rates and in our time loss counts over very recent years. However, what we're not seeing is a corresponding decrease in costs. So what the existing model assumes is that if our time loss claims are dropping, our future costs are going to drop. But when Eckler actually looked at this and plotted the behavior of our claims costs against the time loss claim counts, there was no longer any correlation between the two. As a matter of fact, the gap between claims costs, which are steadily increasing, and time loss claim counts, which have been steadily decreasing, just grew wider and wider and wider. So there's absolutely no correlation anymore between the number of claims and the actual claims costs. What Eckler recommended instead is that you stick to your 5 or 10-year average. But you need to adjust that for kind of the way I think about this is inflation as it relates to changes in the workforce. So what Eckler said is you should look at the change in the workforce, calculate the change in the workforce, and adjust your 5 or 10-year average for changes in workforce. And when we plotted the percentage change in the workforce against the change in the claims costs, there was like almost 100% correlation between the two. The lines were almost one right on top of the other. So what that told us, it validated what Eckler was suggesting, that relying on time loss counts is not a reliable predictor of future costs, but adjusting historic costs for the change in workforce, which is simply the number of workers insured in a particular industry code, is a far more reliable predictor of future spending patterns than the time loss counts. So what that means is we calculate the 5 and 10-year blended average, and we are seeing a 5% growth in the workforce in an industry. We would assume a 5% increase in the costs associated with that 5 and 10-year average. So what would the impacts of that be? Well, if you've got decreasing claim counts, what those claim counts would have been doing is actually pulling down the estimate of what the future costs are. If we release that, if we remove that influencer on the claims costs, it's going to have the effect of increasing your claims costs and driving up your premium rate. If the workforce is not growing or decreasing at the same rate as those time loss counts were. However, the second factor in this, which I introduced when we were talking about credibility, is this whole issue of blending. Eckler said, you don't need to average previous year's premium rate with the current year's premium rate, because again, you're messing with the integrity of the model. If you base this on the 5-10-year experience adjusted for workforce, you no longer have to mess with this blending of premium rates. So if the blending of premium rates had the effect of holding your premium rate down, and we release that, it's going to bring your premium rate up. However, if the blending had the effect of holding your premium rate down, and we release this, it's going to help. I think I got those two backwards. If the blending was holding your premium rate down and we release that, it's going to drive your premium rate up. But if the blending was actually artificially increasing your premium rate and we release that, it's going to bring your premium rate down. So what's the combined effect of those two things? So getting rid of the impacts or influences of the time loss counts, but adding in the effect of the workforce, and then getting rid of the blending. So when we look at M33, which again is the refineries and upgraders, as a result of the adoption of workforce, replacing that instead of using the time loss claims, relatively no impact on the M33 codes, less than 1 cent. And it would have been a decrease. However, releasing the blending, getting rid of the blending, actually reduces the premium rate, so that what the blending was doing was holding the rate artificially high. Releasing that actually would have reduced the premium rate by a penny for M33. When we look at M62, the time loss claims were generally decreasing in M62, which was pulling the costs down. The workforce is far more stable. So by adopting the workforce and getting rid of the time loss counts, actually would increase the premium rate by 24 cents. However, the blending, getting rid of the blending, actually decreases the premium rate by 19 cents. So the net effect would have been a 5-cent increase. For M81, a net decrease of 38 cents. Applying the workforce would have decreased M81s, which is again metal foundries and mills, by 37 cents. And removing of the blending would have reduced the premium rate by a penny. So the net or total reduction would have been 38 cents for the M81 rate code. For M91, these are the ag equipment manufacturers. Adoption of the workforce in lieu of time loss counts would have increased M91's premium rate by 21 cents, and by getting rid of the blending, we've actually decreased the premium rate by 17 cents for a net increase. Whoops, where did I get to here? For a net increase of 4 cents for M91. Now let's go to M92, which are the machine shops. Adoption of the workforce would have increased their premium rate by 44 cents. The blending, however, would have decreased. Removing of the blending would decrease the premium rate by 15 cents for a net increase of 29 cents. M94, which are the iron steel fabricators. The adoption of workforce would have increased the premium rate by 99 cents, and removal of the blending would have decreased the rate by 36 cents. Their premium rate would have increased by 63 cents for this particular recommendation had we implemented this in 2017. Next recommendation has to do with claim cost pooling. Claim cost pooling is directly related to this notion of collective liability, which again has two pieces to it. Employers should collectively share in the liability of all claims in their industry. But secondly, employers should not be unduly burdened for very expensive or unusual claims. Under the current model, we employ some claims cost pooling, but we only apply it to our long-term earning replacement claims, which we often refer to as pensions. So if someone has a serious injury and permanent loss of earning capacity, we will set them up on a monthly wage loss that we call long-term earning replacement, or sometimes referred to as pension. Under the current model, if pension costs on an individual claim exceed $90,000, we cap that at the industry level, and we take the difference between the actual cost of that long-term earning replacement claim and the $90,000, and on the basis of payroll, we allocate it to all rate codes at the class level. What does class level mean? It just means, for our sake of our discussion here this morning, any industry rate code that starts with an M is in the M class, the manufacturing class. There are 10 rate codes that bear an M classification, so they're part of that M class. So if we had a earnings replacement claim, cumulative costs were, let's say, $150,000. What the current model would do is cap those claims costs at $90,000, and we take that extra $60,000 and we distribute it among all 10 M rate codes on the basis of payroll. Eckler said claims cost pooling is critical to a rate-making process. But he said the way that you're doing it has actually two problems. First of all, this $90,000 cap that you have is a fixed number, and it's been $90,000 for a number of years. That cap really should be indexed somehow to recognize that wages and other things go up or change as time goes on. So he recommended that, first of all, we replace that $90,000 cap with a multiple of the maximum insurable earnings. So as insurable earnings increase, and we apply a multiple of that to the claims cap, the claims cap also moves. What the board has approved is we will replace the $90,000 cap with a cap equivalent to 3 times the maximum ultimate insurable earnings, which today amounts to roughly $252,000. So the first recommendation said we're going to increase the cap from $90,000 to $252,000. The second part of the recommendation was this cap should not only apply to long-term earning replacement claims or pension claims, it should apply to all claims. So what that means is if any claims, cumulative costs, exceed $252,000, we will cap that cost at the industry level, and we will distribute the difference between $252,000 and the actual claims costs, not over the class anymore, but over all 50 rate codes, increasing the collective liability over the whole system, not just the 10 rate codes within the M class. So the previous example I gave you, you have a pension or long-term earning replacement claim, costs were, what did I say, $150,000. Under the old plan, we'd cap it at 90. Applying the cap of $252,000 means we will charge 100% of the $150,000 claim cost to that industry rate code. They will be responsible for that. But if we have another claim, whether it be an earnings replacement claim, a fatality, or just a long-term wage loss claim with huge medical attached to it, and the costs exceed $252,000, so let's say we had a claim that cost $400,000, which there's a few of those in our system. We would cap the cost at the industry level at $252,000, and we take the other $148,000 on the basis of claims costs now. We will distribute it among all 50 individual rate codes. So what's the potential impact on the individual M rate codes that we're looking at here this morning? Well, first of all, if you're part of the M class and you didn't have very high pension costs, but somebody else in the M class did, you would have been picking up a share of that pension cap. By removing that, in theory, you should actually see your premium rate go down because you're no longer picking up a portion of the pension cap at the class level. However, now what you're picking up is you're picking up a portion of the cap of all claims in excess of $252,000. And if that amount is higher than the average that you were paying, it would have the effect of drawing your premium rate up. So let's have a look at the M codes and see what the impact is on the various codes we're looking at here this morning. So M33, which again is the refinery and upgrader. The pooling of pension costs used to increase the premium rate. In other words, M33 was paying for excess pension costs in excess of $90,000 and subsidizing one of the other M codes. Removing that actually has the effect of decreasing their premium rate to the extent of about a penny. What they're picking up in terms of their share of the pool in excess of $252,000 actually leads to a decrease as well. So in other words, what they were paying in terms of pension cap within the M code is greater than what they're picking up in terms of the share of the cost in excess of $252. Similar story at M62, which is the mills and semi-medium manufacturing. The change, quite frankly, is less than a penny though, so it really, when we round it, it shows up as zero change. M81, a little different story. M81 used to benefit from the pension cap pooling. When we remove that, because they're not being subsidized by the M code anymore, they're actually going to see their premium rate go up. They're also picking up a share of costs in excess of the $252,000, which is also having the effect of drawing up their premium rate for a total increase, had we implemented this particular enhancement January 1, 17 of 9 cents. M91, which are the ag manufacturers, the pension pooling actually used to increase their rate, but now they're picking up a greater proportion of costs in excess of $252,000. Why would that be true for them and not, say, for M33? It would be because of the relative claim activity, the costs within M91. Remember, we're pooling on the basis of claim costs at the 50 rate code level. So if you've got a high proportion of claim costs going through your rate code, you're going to pick up a larger portion of the claims cost pooled in excess of the ultimate max of $252,000. M92, similar story, but a net increase of 2 cents. And when we look at M94, which are the iron steel fabricators, they were actually subsidizing on the basis of the pension cap pooling, so this has the effect of drawing their rate down. Their costs are quite a bit higher than the average for the industry, so what they're picking up in terms of their proportionate share of the pooling is less than it otherwise would have been, for a total decrease of 8 cents. The next recommendation has to do with the allocation of fatality costs. Under the current model, what we're doing is we actually calculate a 10-year average for all fatalities that occur over the 50 rate codes, and every industry rate code pays exactly the same amount in their premium rate, whether you had a fatality or not. So included in the 2017 premium rate is a 4-cent charge in every industry rate code to fund the average cost of fatalities, 10-year average cost of fatalities, whether you had a fatality or not. Eckler said you shouldn't do that. Eckler said in order to create better accountability at the rate code level, you should actually be charging the rate codes, holding them accountable where the fatalities are actually occurring. So we took that recommendation to the board and said, okay, Eckler's recommendation is the rate codes who have the fatalities should pay for the cost of fatalities. And the board actually asked me a very good question. They said to us, what's the difference between a fatality and any other claim? I mean, other than the obvious difference, from an insurance perspective, there really isn't a whole lot of difference. So the board said, yeah, you should hold the industry that has the fatalities accountable for the fatalities, but you should apply the claims cap to those fatalities as well. So if you have a fatality that costs in excess of $252,000, you would cap the cost of that fatality, charge the industry code that amount, and spread the difference across all 50 industry codes. Now, is that even relevant or important? Absolutely it is. So if you have a single individual who unfortunately dies as a result of their work, the cost associated with that fatality could be just burial expenses of like $10,000. But if an individual who has a spouse and let's say 3 dependent children, the cost could exceed $1.6 million. So the pooling is a necessary, I think, element to maintain as it relates to fatality costs, so as that individual employers or rate codes are not unduly burdened by like those $1.6 million fatalities. So that's in fact what we've done. So we are going to hold industries that had the fatalities accountable for their fatality costs, applying that same credibility measure, either a 5-year or a 10-year average to their actual fatality costs. But we're going to cap those costs at $252,000, just like any other claim. So what's the impact of that? So generally speaking, if the costs of your own fatalities over the last 5 or 10-year average period are greater than 4 cents, which is what you're currently paying, you would see your premium rate go up. If they're less than that, you would actually see their premium rate go down. So for M33, for the last 5 years, they had, so 2011 to 2015, there were 3 fatalities in the M33 rate code, but the cost of those fatalities, average cost of the fatalities, clearly less than the 4 cents that they're currently paying, and therefore their premium rate would have gone down. M62, which are the mill semi-medium, actually had 7 fatalities in that same 5-year period. And the cost of those fatalities was 2 cents higher than the 4 cents that they're actually paying, and so their premium rate would have increased. M81, which are the metal foundries and mills, had 2 fatalities in that 5-year period. Actually seen their premium rate drop by a penny. So the cost of their fatalities was actually less than the 4 cents that they're currently being charged. For M91, which is the ag manufacturers, they didn't have any fatalities in the 5-year period, so 2011 to 2015. However, they are only 76% credible, so we would only be looking at 76% of their 5-year. We would pick up actually a portion of their 10-year, but again, the costs of those fatalities would have been less than the 4 cents they're currently being charged, so their rate would have dropped by a penny. M92 had 2 fatalities. Again, average cost of their fatalities a penny more than the 4 cents they're currently paying, and therefore the premium rate would have increased. M94, that's the iron steel manufacturers, 3 fatalities in the 5-year period. Net cost would have been 4 cents higher, double what they're currently paying under the current model. So you'll see as we go along through the various industry codes and talk about the enhancements, each of those enhancements has potentially different impacts, or would have had potentially different impacts on the industry rate code. The next recommendation has to do with long-term claims. Again, under the current model, we calculate a 5-year average, and we use that 5-year average to predict what the future costs are going to be. But included in that 5-year average are the costs of all claims paid in that averaging year, regardless of the year of injury. So let me give you an example. 2017 premium rates are determined based on the most recent 5-year average. So that would have been 2015 back to 2011. So we would take all the costs in 11, 12, 13, 14, 15, that 5-year period, we average those costs, and that's what we use to predict future experience. But in 2011, there's a good chance that there's a claim in that cost that actually occurred like 30 years ago that is still incurring costs today, either medical costs, could be still wage loss costs, could be independence allowance, whatever. And so what the current model does is replicates that experience. In other words, as it looks forward, it's assuming that 5 years from now, you're going to have a claim just like that would be 30 years old that you're going to continue to pay. Eckler said that's not really reliable. It's not a fair representation and actually is holding down the reactivity of the model because you're pulling in experience on claims that happened potentially 50 years ago that in no way are reflective of the current industry, the way the work is done, the technologies that might be used in that work. You need to look at more current experience as a better predictor and reflector of future experience. Eckler recommended that we should cut off this cost tail and only look at claims in that averaging period that are either 5 or 10 years old. When we ran our analysis, what we determined is by bringing in 7 years of cost experience, we capture 75% of the costs. So the recommendation that went to the board, which the board accepted, is for purposes of calculating the 5 or 10-year average, we will only look at claims that are maximum 7 years old. So if we're calculating a 5-year average, in 2011, we're only going to pick up costs from 2005 forward. In 2012, we're going to pick up costs from 2006 forward. Not all those other costs that are much older claims. And we're going to use those 7 years of cost experience to calculate our 5-10-year averages and adjust that by workforce and predict the future costs. But the reality is we still have to pay for the remaining 43 years. There's still going to be costs in those 43-year-old claims. What we'll do is we'll take the costs associated with those old claims, and again, we'll pool them and distribute them among all 50 rate codes on the basis of their claims experience. So what's the impact of that on the individual rate codes? So if you have a larger proportion of your claims in the 7-year period, in the most recent 7 years, by removing the other 43 years from the averaging process, we're going to drive up the average, and that's going to drive your premium rate up. If the majority of your claim experience is on claims older than 7 years, removing that 43 years of experience and only including the 7 will actually bring the average down and bring your premium rate down. So depending on where the larger proportion of your costs are in that 5 or 10 year averaging period is either going to have a positive or negative impact on the premium rate. M33, really no impact. Majority of experience is in the 7 years. When we adjust for the 7 years, there's really no change. M62, they had a larger proportion of claims in the long-term average, in the 43 years, if you will, and therefore removing that actually has the effect of driving the premium rate up. So if we are including the higher cost proportion of claims only in the average and spreading the difference, so they had a smaller proportion of claims in the long term, not very many costs in the 43. If we remove that, we calculate a higher average for the 7 years, and that drives the average rate up by 3 cents. M81, opposite effect. They have a larger proportion of claims costs in the 43 years than the 7 years. Removing that actually has the effect of decreasing their premium rate by 14 cents had we implemented this in 2017. M91 would have had the effect of actually increasing the premium rate because they have a smaller proportion of costs in the 43. Most of their costs are in the 7 years. M92, most of their costs are in the long term, not in the 7 years. They would see a premium rate decrease of 4 cents. And M94, similar story. Majority of costs in the long term. Removing that would actually decrease their premium rate by 17 cents. Next recommendation has to do with allocation of administration costs. The WCB, like any other business, has their costs fall into 2 categories: fixed costs and variable costs. So fixed costs for WCB purposes are all costs associated with any activity in WCB that is not claims related. So this would be, our employer services area, so the registration processes, the claims processes, the calculation of the premium rates. It would include our infrastructure like IT and human resources. All of those things would be considered to be fixed costs. Our variable costs are those that are directly related to the adjudication or management of claims. Under the current model, we assume that 10% of our costs are fixed and 90% are variable. We distribute the fixed costs on the basis of payroll, so we allocate the administration costs, the fixed administration costs, to all 50 rate codes on the basis of their payroll. We distribute the variable costs, the 90%, on the basis of claims costs. Eckler said that's a good strategy and approach, but when he looked at interjurisdictional comparisons, he found that our percentages were not in line with what he was seeing at other boards where he has done some work. And so he asked us to conduct an analysis, to actually do a review. And so in analyzing our administration costs and separating them into those 2 fixed buckets as I described, what we determined is that our fixed costs were actually 30% of our administration costs and our variable costs were 70%. And so the recommendation that went to the board, which the board has approved, is that we decrease the variable component from 90 to 70%, but increase the fixed component from 10 to 30%. Now, what does this mean in general to industry? If you have high payroll costs and relatively low claims costs, you're likely going to see a premium increase because you're picking up a larger proportion based on your payroll of a larger percentage of administrative costs. The fixed going up from 10 to 30. If you got large payroll, we distribute fixed costs on the basis of payroll, you're going to pick up a larger portion of a larger number. Conversely, on the variable side, if you have low claims costs, because we're dropping that from 90 to 70, you would actually benefit and see a reduction. So what's the impact? For M33, the variable component would actually drop by 5 cents, but the fixed component would go up by 6 cents. So the net result would have been an increase in the premium rate of a penny. For M62, again, which are the mills and semi-medium manufacturing, would have seen the variable go down by 10, the fixed go up by approximately 7 for a net decrease of 3 cents. For M81, would have seen a decrease on the variable. So these are the metal foundries and mills. Would have seen a decrease in the variable of roughly 24 cents and an increase in the fixed costs for a net outcome of 17 cents, increase in the fixed of about 7 cents. For M91, a 3 cent decrease on the variable side, but a 7 cent increase on the fixed side for a net increase of 4 cents. M92, the machine shops, the variable would go down by a penny, but the fixed would go up by that 7 cents for a net increase of 6 cents. And M94, which are the iron and steel fabricators, manufacturers, their variable actually would go up by 10 cents and their fixed would go up by 6 cents for a total increase of 16 cents. So what's the cumulative impact? So for M94, you'll see there was a couple of increases, a couple of decreases, a couple more increases. What's the overall and net impact of this? So when we look at M33, which are the refineries, we would have seen their premium rate decline by 4 cents. They would have seen a 4 cent drop in their premium rate had we implemented this January 1st. What does this mean in real terms? It means that in 2017, M33 employers would have paid us roughly $65,000 less in premium. There are only 37 employers in this rate code, so the average decrease for those employers would have been about $1,760 in total. M62 had absolutely no change. So the net effect of all of the increase and decreases was no change in the overall premium rate. Stayed flat at $2. M82, which are the metal foundries and mills, would have actually seen a 39 cent decrease in their premium rate, which amounts to almost $450,000 in less premium. There are 84 employers in this rate code. The average decrease would have been about $5,350. M91, being the ag manufacturers, would have seen a 20 cent increase in their premium rate, translating into roughly $481,000 in additional premium. Divided among 83 employers in this rate code, would have come to an average increase for employer of roughly $5,800. M92, being the machine shops, would have seen a 29 cent increase in their premium rate. This amounts to over $1.1 million in additional premium they would have paid us. There are almost 1,400 employers in this industry code. The average increase per employer would have been $790. And M94, which are the iron steel fabricators, would have seen a 66 cent increase in their premium rate, amounting to roughly an additional $804,000 in premium. There are 106 employers in this rate code. On average, each employer would have paid us almost $7,600 more in premium. So you'll see the reason that we've decided not to go ahead and implement the enhancements to the model in 2017. If we would have sent bills out that would have had an additional, transitional cost, if you will, of $7,600 as it relates to the iron and steel fabricators, it probably would have had quite a few questions and probably not too many happy people. So the purpose of what we're trying to do today, and have been for the last several days, is simply to educate employers on exactly what the changes are going to be and what the potential impact would be, using the difference between the current premium rate for 2017 compared to the premium rate under the new model as a proxy for what you might expect in 2018. But again, depending on the experience for 2018, that could either mitigate what we're seeing in terms of the transitional impacts, or it could actually exacerbate, make it worse. If your experience is better than your 17, it could have the effect of somewhat mitigating this impact. If it's worse, it could actually have the effect of adding to your woes or reducing the benefit, depending on where you fall in. So what are next steps? This full presentation, as well as all the other presentations that we've made to the various industry codes, are being audio recorded and will be available on our website, wcbsask.com, for you to review. I know we've dumped a whole bunch of stuff on you here this morning. Probably need some soak time. If you feel you need to kind of listen to this again, as painful as that probably was for you, it will be available. If there's others who wanted to join us today but for whatever reason could not, it'll be available for them to view and hopefully come to understand. We do have a good half hour plus available for questions this morning, which we would entertain either here on the floor or online. However, as I said, this might need some soak time for you to digest this. You might come up with some questions as you think about this a little bit more. You can submit any questions at any time up to this particular email address. So there's no need for you to email me individually or fax it. We'd prefer that you use the askwcb@wcsas.com, and we'll respond to you as quickly as possible, just so we can accumulate all these and for the benefit of all others that would be interested in the questions that I asked, we have a central place to collect these. The other piece that we're very interested in is feedback or ideas on how we actually might transition this. So what we're talking about is really a one-time cost, a transitional cost of moving from this old or current model to this new enhanced model. And what we're interested in hearing from you are the options in terms of how we might proceed with that. So obviously we could just say, we're giving it all to you in 2018. Whatever the impacts are, you absorb all of that or benefit all of that in 2018. Or we could consider a transition where over a 2-year period we spread out the impact. So we take whatever the increase is, divided by 2, we give you half of that in 18 and half of that in 19, and then adjust for your experience. Now the issue with transitioning like that is we have to do it both ways. In order to keep our revenue neutral, if we're going to transition the increases, we also have to transition the decreases. So you wouldn't get all of your decrease in 18, we would spread that over a couple of years. We would ask that you go to wcbsask.com/feedback. There's a special section there on our website. There's a little form there with a couple of boxes you can check on the 2 options that I've mentioned to you here this morning, taking it all at once or spreading it out over a couple of years. But there's also a section there for any other ideas that you might have. We would like to collect all that feedback, and this feedback option will be available up to and including April 7th. So we strongly would encourage you provide your thoughts with respect to how we might move from current to enhanced model and mitigate the impacts of this transition. Lastly, it'd just be remiss of me if I didn't remind everyone the importance of injury prevention. We've been on this quest to eliminate injuries in this province in a very, very aggressive way through our Mission Zero since 2008, and significant progress has been made. For 2016, I'm very pleased to report that 88% of the workplaces in Saskatchewan actually went injury-free, 0 injuries. which is actually an improvement over 2015. So we're getting closer and closer to zero, but have a way to go. And by far, the least expensive and easiest to manage injury claim is the one that actually never ever happens. So we want to thank all employers and workers in this province for their commitment to achieving zero injuries, zero fatalities, zero sufferings through Mission Zero, and ask for your continued support and commitment to get us ever so much closer to the elimination of injuries in this province. With that, I would like to open it up for any questions from those of you here in attendance. I would ask that you use the microphones on the floor. We are audio recording this, and for the benefit of all of those online or who might view this later, we would ask that you use the microphones. Those of you joining us by webinar, you can submit those questions, and we will have those read out and do our level best to answer those questions as well. So please, any questions? Nothing online? And overwhelmed. Well, hearing and seeing nothing, I truly want to thank you for taking the time out of your day to be with us here this morning and showing interest in really your compensation system. Look forward to your comments and feedback and any other questions, any questions you might have in the coming days and weeks. It's a little bit better day today, as I said today, but still, I think fairly dangerous temperatures out there. I'd ask you all to take care in your travels, and even your walking. The streets and sidewalks are still extremely slippery. Please do have a very, very safe and healthy day, and thank you very much for joining us here this morning.